Hello everyone, welcome back. I got some really good ones for you today. But first, I hope you've been having an awesome week. Markets certainly haven't been, so let's jump right into that. Three major US stock indices have gotten beaten up pretty good this last 2 weeks since I've done a video, today being no exception. That dollar, relative strength of the dollar, not the absolute strength, but the relative strength of the dollar continues to put downward pressure on risk assets. These rising yields, these rising rates, that 10-year yield hitting 3.7%, the short end, so the 2-year bond yields coming up as sharp as they have, kind of inverting that yield curve. A lot of wonky, wackadoodle stuff going on in the dollar credit markets. That's what's freaking out risk assets like Bitcoin, NASDAQ, oil, gold. Fed's letting air out of the tires. They came in with a 75 basis point hike this week to the Fed funds rate, putting the Fed funds at about 3% right now. A lot more hawkish than I ever saw coming along through this video blog series. We have a Fed that just continues to tighten. They need to, so I'm really not a hater. We're at about 12 to 20% inflation per year, depending on how you want to calculate it, year over year. So, it's going to take a Fed funds rate of 18-20% to get the interest rate into truly positive territory, and we're only able to make it up to 3% in the Fed funds rate. Yield still being negative in real terms, we'll call it 12%. And yet the market is just vomiting all over the floor. So even with real negative interest rates, the market is just pricing in a Fed that is not going to stop. I will say, though, for all this hiking we're seeing out of the Fed and this hawkish rhetoric, and the Fed balance sheet, if you Google it right now, Fed balance sheet, and then you click on Fed balance sheet trends, that thing's barely come down at all. We're still over $8 trillion on the Fed balance sheet. So to truly follow through with quantitative tightening, not only should the Fed be raising their Fed funds rate, which is now up to 3%, to call it 18 or 20% to stop inflation, or we can call it 10 if you want to go easy on the banksters. You also would need to see the Fed roll their balance sheet all the way down to call it $1 trillion, something like that, 3 trillion, to say that you've at least given back most of what you added to your balance sheet when the virus first broke out. So, I guess what I'm getting at is, the hawkish rhetoric and the hawkish tone out there, and the aggressive Fed, and the fear and the doom scrolling going on, and the fear porn. I mean, I guess there is a case to be made for all that. You got a strong dollar, rising yields, right? Rising rates, mortgages in the danger zone. But on the flip side of that, we got midterms coming up. I think the Fed is front-loaded some of their more aggressive hikes and can start to flip a little bit more dove. So that would be really good for risk assets like NASDAQ, oil, gold, and Bitcoin if the Fed were to just tone down their hawkish rhetoric, which, I mean, my gosh, the market has priced in a lot of hawkish rhetoric by now. So I'm tentatively bullish because I want to see the Fed, who's been letting tons of air out of the tire, kind of put some back in. Now that they've created a little bit of disinflation and given the middle class about like 5 whole seconds to catch its breath, it wouldn't be surprising to me at all to see that dollar in relative terms weaken, mortgage rates to even like come down a little bit, yields to come down a little bit, and just kind of give risk assets a little bit of room to recoup some of their losses. So that's kind of what I see playing out, but I could totally be wrong. If that 10-year yield, which is now 3.71%, were to hit like 5.5%, 6% over the next, call it 3 months to 6 months, we might not be done yet, and that could put stuff like something like Bitcoin at 12,000, or something like gold at 1,500, or silver back to like 18, NASDAQ all the way down to maybe like 7,500, 8,000, something like that. S&P 500 down to like 3,000. crazy stuff going on. So Dow Jones right now clinging on to 30,000. Okay, that's a pretty strong psychological support. Could the Fed let air out of the tires to the point the Dow Jones hit 25,000 though? Absolutely. Would that put yields and rates much higher and things like Bitcoin and oil and much lower? Absolutely. So, you know, it's a possibility. Play your hand accordingly. Everyone's kind of in a different spot, sees things a little bit differently. I'm just trying to give you my perspective so that you can make the best possible decision for you. No buy or sell recommendations or anything like that. I want to see a market that has been vomiting all over the floor for the entirety of the year to kind of chill. Yields to come down, rates to come down, dollar to come down, Fed to tone down its hawkish rhetoric, flip a little bit more dove. Look, they can still deliver the interest rate hikes, okay, but just not at 75 basis points every meeting. Even though they never hit the Volcker level of 1% a meeting. That's like true hawkish behavior right there, is when you just, Wall Street's burning you in effigy because every FOMC meeting you're just raising rates 1%. Like, deal with it, because I'm going to beat inflation. That's kind of what Volcker had to do in the late 70s. We do have a Fed that's trying to act like Paul Volcker, but I don't think really we have a global economy that can handle that. Things are a little bit more complex as far as the global economy is concerned. Inflation globally being a phenomenon right now, it just kind of paints a little bit different picture of where we're at than, say, in the 70s when Volcker needed to break the back of inflation by raising those mortgage rates all the way to like 21% in 1981 or 1980, I believe. So I don't think we're going to have a Fed that's going to deliver on that. I think we're going to have a Fed that has created a little bit of disinflation this year and maybe given the middle class, the working class, whose wages have not risen at all hardly, a little bit of breathing room because oil comes down, groceries come down, the CPI kind of comes down a little bit. But are they going to just keep tightening and then create a bunch of deflation and then we're just going to end this 40-year credit cycle? I'm not convinced. If we are, I don't even know what the next monetary system is going to look like. So that's like its own rabbit hole. And, you know, we can actually discuss that here. Okay, let's do that. All right, we're getting down into the weeds here, so just hang on every word, and we're going to, you know, this helps me too, though, okay? And we're going to kind of paint a picture here and sort everything out. All right. Although ultimately, I do believe this party ends in hyperinflation, a dollar collapse, asset prices hyperinflating, wages not keeping up, and our economy, if not domestically, even globally, starts to look more and more like Argentina and Venezuela. Although I do believe this party ends that way, there is a dollar milkshake in full effect right now. So let's talk about the dollar milkshake theory. As the U.S. government or just U.S. banking institutions issue loans down the fiat global Ponzi to all these other countries, you know, central banks or their own financial institutions, as all those dollars flood down the Ponzi and leave the country, those are all loans due back to the dollar empire plus interest, creating a situation that no matter how big the money supply gets in the vacuum of space, it doesn't really matter how big the money supply gets, because a lot of that inflation is getting exported to other countries and other institutions and other banks in America too, sure. And those loans are due back plus interest. So there's always more demand for dollars than dollars exist in the system. So although the money supply and the Keynesians are incorrect and the Austrians are correct, that although expanding the money supply is inflation and does create inflation, you don't really see the effects of that inflation if that currency is the world reserve currency like the dollar, so it can be exported to other people around the world's balance sheets, and believe me, they want to hold these dollar reserves, or they're taking on dollar loans all due back plus interest. So A lot of our inflation can be exported and hidden. I don't know how much longer the dollar empire will be able to play that game. And look, I'm not picking on America, okay? I love the US, served this country, I love America. This goes for any world reserve currency, okay? If they're the world reserve currency, it used to be the pound sterling. It's been, Spain had it for a while. The Netherlands, believe it or not, was the world reserve currency some hundreds of years ago. Whoever it is, they can export a lot of that inflation to other countries. And they don't see massive hyperinflation inside their domestic economy unless all those dollars come back to the domestic economy, start chasing the same amount of goods and services. Only then can you really have the stage set for hyperinflation. It's easy for countries like Venezuela and Argentina to slip into hyperinflation because their currency is not the world reserve currency, okay? Argentina is not exporting Argentine pesos all over the world, and then a bunch of Americans are buying Argentine pesos and saving in Argentine pesos. But you know what is interesting? Argentine citizens right now who are dealing with like 100% per year inflation and a interest rate of like 56% right now, which is really bad. I feel really bad for those people. They're saving in US dollars. So if you go to these countries like Argentina or Venezuela, the people, even though the dollar has issues and in absolute terms the dollar is getting incinerated, even in spite of all those things, people continue to save in dollars. Dollars are still stable. They still relatively stable, liquefy the entire global Ponzi, right? All oil trades between even different countries have to be done in US dollars. And then a lot of times that leftover money after that oil transaction is dumped into US equities. So the dollar empire derives a ton of hidden benefits from being the world reserve currency, the petrodollar status, having those trade lanes open and being able to kind of have freedom of movement all over the world, having a monopoly on the use of physical force. People say the dollar's not backed by anything, but it's totally backed by those things. So that's kind of like the dollar milkshake, that although there's been massive inflation inside the credit system and there's been massive money expansion, it hasn't manifested itself in like hyperinflation in your economy when you go to like Sonic or you go to Target and go shopping, or you go. Now we are seeing some amount of inflation, so it would, and it's not nothing, it's bad. So safe to say maybe the dollar empire isn't getting away with what they got away with post 2008 when they did QE 1, 2, 3, 4 under Ben Bernanke, and then got to say, look, there's no inflation. We did all this QE. We bought all these mortgage-backed securities. The Treasury issued a bunch of Treasury bonds and got a bunch of free cash. Look, no inflation. We got away with it. Well, we're getting that inflation in spades now. So I do think there is a bit of de-dollarization going on. I think other countries are dumping their reserves slowly, and maybe China and Russia start creating some sort of axis where they're trading oil in something other than US dollars. There's rumblings of that, right? There's rumblings about CBDCs and things like that. So there's something coming along to change the whole regime up. And so that's another possibility. So those are the two main paths: hyperinflation, and this party ends in just a dollar collapse and asset prices just skyrocketing, and it being pretty horrible. But ultimately, you see the Dow Jones just go straight up, just like the Venezuela stock market. But everybody starts starving to death anyway. Although I believe ultimately that's how this party ends, I could totally be wrong. And here's another way it could end. Let's say interest rates, bond yields continue to go up, and let's say the Fed does meaningfully roll off its balance sheet and like crash the whole global economy. Well, what next? With a crisis like that, we could reset the monetary system, and it could be the Fed's CBDC, so central bank digital currency, which they're working on it. You can look that up. it could be something like that, and then they like airdrop them into people's wallets like willy-nilly, kind of go a direction more or less kind of like a blockchain like thing, and the dollar empire maintains its position on top, or the dollar empire just goes away as a world reserve currency status, somebody else takes over. But here's the thing, if the dollar loses world reserve currency status, I don't think that's deflation. I don't think that means, okay, then the US stock market crashes. I mean, maybe, but how many more dollars would get printed to counter that out, you know? So it's really hard to say whether this is going to end at Dow Jones 100,000 or Dow Jones 10,000. Culturally, in America, Westerner, like I would say Americans specifically, we're very worried about deflation, okay? Because our grandparents went through it, the Great Depression of the 1930s, and that kind of deflationary death spiral just traumatized the American psyche and American culture. But if you were to ask like a German citizen who lived through Weimar, or like an Argentine citizen right now, or a Venezuelan right now, what do you think is the worst? Deflation, everything crashes, or hyperinflation? They'd probably say hyperinflation is the worst thing ever. And so that, you know, cultures that have been scarred and traumatized by hyperinflation might be less concerned about deflation, right? And so that their biggest concern would always be inflation getting away and running away and the currency collapsing. An American might say, no, I'm never worried about runaway inflation, hyperinflation, the currency collapsing, and I am deathly afraid of my 401k getting cut in half, or my real estate getting cut in half, or my stock portfolio or my cryptos getting, you know, cut by 75%. That's what scares me more than anything. And because so many Americans collectively, and they own these things, are so afraid of deflation and brainwash, I guess you could say, everyone into believing deflation is just the absolute boogeyman and inflation's never really the concern, well, then they get to inflate. You see how they did that right there? They got you so worried about deflation that they just, we leaned too much towards inflation. Because we were so afraid of deflation. We were so afraid of deflation, we ran ourselves into hyperinflation, as opposed to being a culture that's so afraid of hyperinflation, you end up in a deflationary death spiral. So just my thoughts on kind of like which way this goes down. Dow Jones 100,000 or Dow Jones 10,000. The big thing would be... the big thing concerning me would be Dow Jones 100,000. And given the knock-on effects of policy and what these policies have been like, look, we got UBI coming any minute, okay? Universal basic income, they're going to start just giving people $500 a month because wages have been flat for 13 years and the Fed just can't not keep everything propped up. So I believe with the kind of government that we have, the kind of economic system we have, which is a debt-based monetary system, which means you have to just print money in perpetuity just to remain where you are, never mind additional growth and productivity. I think because we live in that kind of system, and because we're so culturally scarred by deflation, we're going to end up, I think, accidentally overdoing it in the way of inflation, especially if all these other countries, institutions that are holding treasuries, dollar reserves, were to say, hey, the dollar's losing its status as the world reserve currency status. Let's dump those dollars. Let's give them back to America so that they can all enter the domestic economy and all chase the same amount of goods and services and create hyperinflation. I mean, that it could potentially happen, and that would be what I'm more concerned about than anything. I do think, though, Europeans are getting squeezed pretty hard by inflation by now, and it's looking like it might be a pretty dark winter with energy prices. Could we see Germany paying like a $15 a gallon equivalent for gas this winter, and their heating bills go up to like $500, $600, $700 a month to keep their homes warm this winter? Could we see something like that? CEO Chevron saying it could happen. CEO Chevron came out a few days ago pretty concerned about the direction of oil and natural gas prices going into the rest of the year. So WTI crude right now is only $83 a barrel. I think that number by Christmas could be 150. It could double about. And that sounds crazy. That sounds so nutty, but I could totally see it in the cards. So I'm worried about WTI crude going from 83 a barrel up to 150 by Christmas, not the opposite, where like all your oil stocks crash and oil keeps getting cheaper. But I could totally be wrong about that. Kind of hope I am. Kind of like I would like to see the Fed balance sheet get shrunk back down to like $1 trillion. It's like 8.2 trillion right now. They've barely rolled off 800 billion. That's a lot of money. It's hard, but in the grand scheme of things, you look at that Fed balance sheet, it's just barely dipped. Maybe they're gonna just keep that thing inflated, or level it off, not let it dip, not tighten in that way, and then just keep raising the overnight rate for banks and being like, look, we're raising interest rates for solving inflation. But then you look over at their balance sheet and you're like, that balance sheet's gone nowhere. You need to roll that thing off for me to be convinced. You need to jack up the interest rates, jack up the bond yields, roll off your Fed balance sheet all the way back down to zero before I'm convinced that you're pushing policy to positive territory. So like, I'm looking for that, but I doubt they're gonna do that. I think they're gonna jawbone about getting inflation under control, maybe raise interest rates a little bit more. Like, I would expect some 25 or 50 basis point hikes in the future, but I think the 75 basis point, 100 basis point talk, I think we're pretty much done with that, especially given kind of like the political backdrop we have going on. I think the next few months we're gonna see the Fed start to act a little dovish. I thought the Fed was gonna start acting dovish at the meeting we had this week because of the midterms, but no, Powell seemed undeterred. So I could totally be wrong, but I'm not freaking out about the Fed letting air out of the tires. You shouldn't be either. I still like my risk assets. I still love NASDAQ, oil, gold, Bitcoin. Like, that's what's up to me, but I could totally be wrong, and we're just gonna have to see. It does look like the NASDAQ's trying to put in a double bottom right now. S&P 500, Dow Jones, they hit kind of their lows in mid-June, and we popped up, and now we're revisiting those lows. I'm not gonna get too much into technicals. I will do a video on technical and fundamental analysis at some point in the future, I'm sure, but I don't know. We'll see if we put in kind of a double bottom. We'll see if that Dow Jones holds 30,000, but maybe not. Maybe the Fed will let more out of the tires. Dow Jones will go down to 25,000, S&P 500, down to 7, 8, whatever. NASDAQ down to 7 or 8,000, S&P 500 down to like 3,200 or something. I don't know. Bitcoin down to like 14 grand. I don't think Bitcoin, here's something on Bitcoin. I don't think Bitcoin is gonna go below 7,000 ever, because that's how much electricity, about $7,000 worth of electricity it costs to mine a Bitcoin. So I doubt Bitcoin will fall below cost. If it did, that'd be pretty epic and historical. But I don't think Bitcoin is even gonna fall. But guys, to be honest, I think Bitcoin's gonna hold the 17,500 to 20,000 range. I really do, even with this hawkish Fed and rising yields and rising rates and all this fear and doom porn out there and deflationist out in full force. I think Bitcoin has just been beaten black and blue, and it would take so much more to just smash it further, because a lot of these institutions showed up at 19,000. They walked through the front door, set up their little prop trading desk, drank the Kool-Aid with Bitcoin, and now the price is back where it was when Morgan Stanley, Fidelity, BlackRock showed up at. So they could start just shorting it and just go net short somehow and really manipulate the price south. But I think low-key too, all these banks like Morgan Stanley and Fidelity and BlackRock are, if anything, trying to use this fear right now to buy. I think they want to get as many people short-term on the wrong side of the trade as they can. That's where the premium is buried. If they're buying quality at the point at which nobody wants it, because you have a tightening Fed and slowing global economy at the same time. Nobody wants these things. They get really cheap. We're already there. Don't miss the bottom is all I got to say, right? Like, because that's one problem with the deflationist, is sometimes they're always expecting more damage than they ultimately get. So Dow Jones at 30,000 right now. There's going to be deflationists out there that are saying, I'm not going to buy till 20. And we could hit 25, 26, or even like 28, and we never get to a point where they feel like it was cheap enough for them to enter, and they just miss the bottom, and the next thing you know, they're just buying the top again, and they're just chasing. So if you are, just kind of sitting on the sidelines and trying to time your entry, good luck to you. I hope the best for you, for real, I do. And keep in the back of your mind, maybe some of these things that are on my shopping list aren't gonna hit the price point I want them to, especially if at the first whiff of dovish rhetoric, these markets are just gonna start to reinflate. Kind of my thoughts on everything. It's really all I got for right now. So it's been a pretty nasty 2 weeks since my last video, but hang in there, be positive. It's all good. And honestly, I'm not too bummed about this, because seeing a little disinflation isn't the end of the world. So one more thing, and then I'm gonna let you go. So you have deflation, disinflation, and inflation. Okay, I'm gonna go through the different asset classes, and first I'm gonna tell you about what they are, what these things mean. I'll give you like the difference between deflation and disinflation. I'll tell you the difference, and then I'll tell you how I think it kind of loosely applies to a couple asset classes, and then I'm gonna let you go. So disinflation is when you still have inflation. So like 1 month you'll have 3% inflation, but the next month you only have 2% inflation. So you still have inflation, but that rate of inflation is falling. That's disinflation. Deflation is just where you have like negative 2% growth or whatever, next month -3, -4, or negative 2% inflation, -3, -4, and you're just kind of already in a deflation, and that rate is getting worse. So disinflation, you still have inflation, but that pace is slowing. All out deflation is just like runaway prices are falling. And then inflation is prices are rising, and the rate at which they're rising is increasing. So you have like 1% inflation 1 month, 2% inflation the next month, 3%. That's like good old-fashioned inflation. Gold loves inflation, doesn't like disinflation, in my opinion, and hates deflation. Bitcoin loves inflation, especially when the market's trying to price it in and front run it. Same with gold. So Bitcoin loves inflation, doesn't like disinflation, hates deflation. Just my opinion. Stock markets love inflation, don't mind disinflation that much, hate deflation. And then I would say real estate, especially against this backdrop of like low inventories and low growth. Real estate really likes inflation, maybe doesn't really mind a little bit of disinflation. Like it doesn't beat up real estate as much as you think it would. And then all out deflation would just scare the heck out of real estate. So that's just kind of like your crash course on disinflation, deflation, inflation. And you see how like commodities and non-productive clumps of atoms like gold or non-productive bitcoins in your wallet, you see how they would really love inflation because they're competing toe to toe with the dollar, but then they just can't handle the other two in any capacity. They don't like falling inflation. Gold hates that. And they don't like just all out deflation. So there's your little crash course on that stuff. Deflation, disinflation, inflation, kind of weird. A lot of technical terms in finance. Always bring it back to just keeping it simple though. These people use complex terminology on purpose to make you feel inadequate and them to feel like they're the only ones that can help you, and to just kind of like justify the $3,000 suit or whatever. Like, look at me, like quantitative easing is a perfect example. It's just money printing, all right? But you got to give it a cool word like quantitative easing. You got to say words like transitory. You just got to say weird words that make the other Stanford graduates like, oh, that's a real SAT word. And then you can start adding zeros to your salary and, confusing people. Just joking. You guys are awesome. That's all I got for you today. I hope this helps. I hope I'm wrong on some of this stuff. Totally could be, and that's all I got for you for right now. Till next time.